So we're live. Jeff, how are you, man? How are things?
I'm good, very good, thank you. And we need to arrange some golf soon, right?
Absolutely.
Well, it's
Absolutely. The
really
weather's starting to get very nice. For you, for those who are in New York, unfortunately, you're not seeing the kind of weather that we are
okay.
down
Okay.
here in the Southeast. So, Jeff, listen, I want to do, I don't want to embarrass you, but I'm going to do a little bit of an introduction because I think it was good for people to see who you are, and then we'll just have a nice conversation about things. So, Jeff, I know you call yourself today an independent emerging markets commentator, which I find kind of funny, but uh, to me, you'll always be one of the top award-winning EM economist that has been around. I mean, there aren't too many around today, but in the EM heyday, you were definitely one of the go-to guys out there. And I think people will realize that from just to give you some background, you are from the UK. You earned your degree in economics from University of Durham and your master's from University of Warwick, both in the UK. You started your career at, which is interesting. We never talked about this in general, but BIS, the Bank of International Settlements, which obviously is probably a story in itself. And then you started your career, a long career on Wall Street, starting with James Capel in London, then to New York. James Capel is something I guess we can explain, but it was one of the original banks, investment banks, focused on emerging markets. Had a very very long history. Then you became a Latin strategist and head of research at Bear Stearns, where we were colleagues for a number of years. You spent 14 years at Citibank as the global EM strategist, equity strategist, and head of Latin American research. And then in 2013, you joined UBS as head of their global emerging market equity strategy. And then you retired a few years ago. I know, sorry, Jeff, that was a little exhausting. I'm only kidding. But I think it's important that as we talk about these things, for people to put in context of your background. And I know, and I think it's important that you have talked with, consulted, and advised some of the largest investors in the world, including sovereign funds, the Fidelities, the BlackRocks, and I think that's really important. So, as we go forward, I think that's interesting to put in context. So, before we begin, I guess what I wanted to ask you was, how did you go from being a trained economist to become a strategist analyzing markets? And so let's talk about that, and then I could throw something else at you. But that would be an interesting question.
I always used to say, Tom, and thank you for the very kind introduction. I always used to say, Tom, like a lot of grey-haired economists, I eventually became a strategist. I think some people eventually find pure economics in the markets a little kind of boring and repetitive, whereas strategy for equity markets, or indeed any markets, is always very interesting. Every day is different. But to be more specific, I moved from economics to strategy in 1991 when I was offered the chance to go and work in the US. Actually, for the second time, I worked briefly in the US while at James Capel, which eventually, of course, became HSBC in 1988, 89. And then I went back to the UK. And then I was offered the chance to come back to the US to be what I always refer to as the global end of the strategy product. So I became the global strategist based in New York, really not necessarily the global strategist per se, but more the global strategist who was in contact with US institutions. And that was the moment when technically I moved from being an economist to being a strategist in terms of title. And then a few months after that, because it is very important that I say this, is that a few months after that, suddenly, 1991, all this business in Mexican equities fell through the door of James Capel. It was the time, of course, under President Salinas, of privatization. The companies Telmex, Banamex, etc. And we had 70 people in New York, and they looked around the room and said, well, who's called a pen? And I was the obvious one. And so they asked me then and there to move to emerging, to build a research team, and then become the strategist for that. So I went from economics to part of the global strategy team to emerging markets, specifically first Latin America. And that's why it happened. And I never really, quote unquote, chose it. I was just offered these opportunities. And and that's why it happened. But as I may make one other point, is that the other interesting thing about it is that, especially in emerging markets where macro issues are so important, you never leave your economics behind. I would still use it de facto most days, that background, even though my job technically, not technically, my job at the time, for all the rest of my time in markets was to be a strategist for equities, but always using that economics.
Thank you, Jeff. Hey, I know we want to touch a lot of things around the world, but I want to ask you about your opinion on what's going on in the U.S., kind of in an EM context, in terms of macro context, especially the fact that today the U.S. recorded, I think, was the second highest deficit in the history of the United States, since we've been tracking deficits, I guess, in the early 90s. But given that a massive deficit was the trigger for the 87 crash, the beginning of the 87 crash, when the market went down 22%. It was triggered by a larger than expected deficit. So given that context, what's going on in the U.S., Jeff, with deficits? Everyone's talking about deficits. The financial pundits push them away, and then put the U.S. in a little package, a macro package relating to EM, and then we'll just go around the world.
Right, this might take a while. I remember very well that in my final job in the markets with UBS, our global head of research was very keen on scenario analysis. And sometimes you push back on that because you feel you know what the scenario is and you want to focus entirely on that. But it wasn't exactly an either or, because I feel that, especially on the sell side of the business, you really have to make your mind up in terms of your view. Today, where we are at the moment, this is a wonderful example of the need for a scenario analysis. Now, for me, there are, talking about tariffs specifically, we wait to see what's going to happen on the tax cut front, because of course we haven't heard anything specifically on that. Although, let me just say as an aside, apropos of the budget deficit, I tend to believe that the actions that the government is taking, and Elon Musk is playing a big role here, to shut down USAID, to offer the chance for various public sector employees to effectively take retirement, isn't going to make a big deal of difference on the deficit, because it's small compared to the money spent on interest payments, defense, entitlements, Medicare, Medicaid. But still, it's interesting because it's nice to see what impact it would have on the deficit. The scenario analysis I'm going to talk about is vis-a-vis tariffs. Are we going to have tariffs, or are we not going to have tariffs? So obviously, the ones that are in place now are with China. We accept that's a little different from where we were 2 weeks ago when President Trump took office again. Let me just sum this up this way. If we are going to have significant tariffs, as opposed to this just being quote unquote transactional to get other stuff, we're going to have significant tariffs in countries like Mexico, countries like Canada, and of course Europe as well. I think the following market responses are appropriate. Dollar is higher. US outperforms emerging markets partly because the dollar is higher. Bond yields probably don't do very much until we see more about the tax cut side of things, because obviously it's the deficit issue to do with tax cuts that could push bond yields higher. But because tariffs tend to, at the margin, they won't be passed through entirely to prices, but they will have a positive effect on internal prices in the US. I think yet more and more reason why the Fed is going to say, I'm not going to do anything very much, I'm going to wait and see. That was the scenario I favored just as recently as Monday. If you read my post on LinkedIn on Monday, it almost reads like a historical document, because it was couched in terms of these tariffs are coming in. Now, and in that environment, as I say, and that was my 2025 outlook, that EM has a difficult year, probably underperforms the US again. If you go the other way, and there aren't going to be any tariffs at all, or any tariffs of any significance on Canada, Mexico, Europe, etc., we just have a sort of minor, what should we call it, intensification of the trade war with China. I think what happens then is that the dollar falls, which of course it's done year to date, although it's been bouncing around a lot. Bond yields probably fall in the short term. And all of those underperforming equity markets in EM that did so poorly last year, Brazil being the poster child of that, will do very well because, as you know well from all the work we did together over the years, Tom, the best news for macro news for emerging market countries is a weaker dollar, which will encourage investors to dump the US and look overseas for more yield, for more risk, whatever it might be. And there's no doubt in my mind that one of the reasons why Brazil is doing so well, even Mexico is doing well this year, despite all the stuff going on, is because people have been contrarian. Let's buy the losers from last year. Korea is another great example of a market that did very poorly last year, which is up this year. Taiwan is down. India is down. So there's been this sort of rotation effect. And that would be encouraged, exacerbated, whatever word you want to use, by a no tariff scenario, which would bring the dollar down, would bring Fed interest rate cuts back on the table. It would probably not do very much again for bond yields, except down the road. I think they'd rise a bit, but down the road, it would partly depend on tax cuts. And it would be a great environment to put money to work in emerging market equities, especially some of those which are cheaper and have done so poorly in the last couple of years, partly because the dollar has been so strong. Now, I favored the first scenario in my year ahead piece, and right now that doesn't look like a great call. I took Trump at his word. We're going to have tariffs, and sure, we may still have lots and lots of tariffs, but right now it looks like scenario 2 is a little bit more the bet that's going on. And this is why some of these emerging ones are doing very well this year. And the asset class as a whole is up about 2%, which is no great shakes, but it's better than being down 5%.
Yeah, I think the one thing that, the one country that I think people have the most misunderstanding about is China. Mm-hmm. And the issue I have with sort of the consensus out there about China is, number one, people are forgetting China is in a major economic decline right now, and demographic decline and economic decline. So from your perspective, I mean, this worry about China, I mean, you saw, for example, Panama saying we're not participating in Belt and Road. In fact, Belt and Road is dead. Belt and Road has lost hundreds of billions for the Chinese government. I mean, everyone's defaulted on Belt and Road, so that's how they play. But why is there still this belief that China's going to take over the world? First of all, do you believe that, number one? And number two, talk a little bit about Trump and potential things that could happen with China on the trade front.
I don't believe China is going to take over the world. In fact, I think one of the medium-term trends in emerging markets, which I get asked about a lot, is that I believe truly in the next 3 years or so, India will become a bigger market in EM than China. China's around 26-27% now. India's around 20%. And of course, they've been converging slowly over the last 1 to 2 years. Now, you and I don't always agree on everything, Tom, but we agree on this. And that is that I think the challenges in the Chinese economy are still absolutely enormous. I don't think the tariff fight with the US, which could go further, we just don't know, particularly makes the challenges that China is facing worse. But for me, the issues are very, very simple. You mentioned the population decline. That's terribly important. But in terms of getting growth going, and in terms of, therefore, economic growth and translating into companies doing better and therefore corporate earnings growth, you've got to solve two things. Whatever the GDP data says in China, which I think is bad data, basically. And people have said that, of course, for years and years. You've got to get two things. First of all, you've got to solve the property sector issue. And if you don't do that, you're going to have some sort of a version of what happened in Japan after 1989 for basically 30 years. There's a drag on the economy because of all the bad debt on banks' books and the collapse of real estate prices. etc., etc. We don't hear about it much anymore, but a number of property companies in China have basically gone bust, and we really are not doing anything other than scratching the surface of dealing with these hundreds of thousands of properties that have been built or are being built and are not being occupied. As your listeners will know, I'm sure, a lot of the issue in China is that people have put money down to buy these properties, individuals, consumers, whatever you want to call them, and the properties are not finished. So they basically, at the moment, put that money down a hole and are not getting anything for it. So that involves the need to, in my opinion, restructure bank balance sheets, restructure property sector, property companies. That is a huge overhang on the economy. The more conventional, secondly, the more conventional challenge China has is to increase the share in GDP of consumer spending and reduce the share in GDP of investment and of exports. Now, the government appears to be very, very reluctant to do this. I think there are things they can do. They've got a bit of fiscal room to do this. Consumer spending over GDP is about 45% in China. In most other countries, it's between 60 and 70, and in many developed economies, it's around 70%. That's the gap that has to be filled. And until you get the consumer going again, that will also be a drag on getting the economy going and then again getting corporate earnings growing. So, in my opinion, those are the two big challenges. The government should know how to do this. They just don't seem to want to do it. I don't know why, but you have to have expansionary fiscal policy, not focused on getting corporates to invest. There's too much investment in the Chinese economy, especially in property, but to get consumers to spend. Now, I have argued for 2025, and this is true whether we're going to have scenario A or scenario B with respect to tariffs, that India as a market will outperform China. Now, India's had a poor start to the year. China's had an average start to the year. I still think that's the way to go, because although you had this super rally in Chinese equities in the fall on the real expectation you were going to get fiscal action, which would try to solve some of the issues I've mentioned there, we're still waiting for that to happen. And I think there's a tremendous desire of investors in emerging markets and indeed generally in the world to bottom fish in China after 3.5 years of dreadful performance. Well, the last 3 months after the big spike in the fall has really not made that a very good strategy. So I'm very cautious about China, the economy. I'm very cautious about the market until we see some more action by the government, which doesn't appear to want to take that action. And meanwhile, a big tariff war with the US is going to make things worse for China in the short term.
So, when we talk about emerging markets as a general term, people look at it and say, how can I invest in emerging markets? I think that this whole index approach that we've seen, not just in emerging, but in the US and everyone just buying the S&P 500, I think that's, I don't know about you, but I think that those days are kind of fading. And I think it's going to be more of in places like the US stock picking, and then in emerging markets, it's the right countries. Do you agree with that scenario? How do you see things moving forward for someone who's interested in exposure?
I do see that as the correct scenario, although I've always been of the opinion that while a lot of especially the long-only funds, perhaps only the long-only funds, have to beat a benchmark, there's still a benchmark there, and therefore they've got to take note of the benchmark. But the reason why I think that is true, is because I argued in a piece I wrote late last year that in terms of performance, and this was around the time China had the big bounce, and it was a big bounce, we didn't have the Magnificent Seven in the emerging markets. We had the Magnificent Three, and they were not stocks, but they were actually countries. And the Magnificent Three were Taiwan, India, and China, who together made up far more than the modest increase in the emerging market index last year, which means net, the other 21 countries in the index contributed negative performance. And if make one other point as well, given the incredible success of TSMC and how it's very much in the forefront of investors and even markets generally, their focus, TSMC today is more than 10% of, at least it was at the end of December, maybe a little lower now. Taiwan's down a bit this year. Is more than 10% of the index. So, it's a huge and double the weight of any other stock. Now, if you add to those three, Korea, which has had a tougher time lately, you've got 75 to 80% of the index, and the 20 countries that's left account for 20 to 25%. Now that makes it very hard, for long-only investors to ignore the index because you've got to do well in those countries. But by the same token, it gives those folks who don't have to follow an index and are only interested in absolute returns to comfortably have a view on those countries, but to invest more broadly. And that is so different from the world even just 15 years ago, let alone 20, 25 years ago, when the biggest country in the index might have had a 12% weight. China's weight today is 26, 27%. So the way in which it's become a big Asian market, emerging market index is a fact. It will impact long-only investors and what they're going to do vis-a-vis the index, but it's the sort of thing that is going to encourage other investors to ignore the index, to invest where they think there's return. And of course, within that, as you said, Tom, it will lead to investors trying to do some serious, stock picking particularly within some of those smaller markets. Now, the macro affects all these markets. Brazil's had is not a huge market. It's about 4.5%, 5% of the index now. But as the macro trends develop, some of these bigger markets, huge markets, may see their weight coming down, and there will be macro trends within that, such as people buying Brazil, big market, lots of stocks, had a bad year, currency starting to rally, let's go in. But overall, I think you're right. It's very hard, unless you have no choice but to benchmark it yourself against the index. It's very hard to say that the MSCI EM index today really reflects a very interesting representation of what quote unquote emerging markets are.
Yeah. So what do you before we leave Asia? What do you think India, from an economic standpoint, is doing right versus the rest of Asia? I mean, in taking out the massive size of it, but they are doing things. Let me ask you, what's your opinion? What are they doing right fiscally and economically?
Well, the first thing about India is to remember that we always used to say, and it's true with India today, and it's true with a number of other countries. Indonesia is a good example, although they're having a fairly tough time this year. Is the poorer you are, and the bigger the population is, and the better the institutions are, those sort of combinations, the better the growth prospects. And I was last in India, as a tourist, if you like, about 6 or 7 years ago. And obviously things have moved on from there, but it's still staggering, the level of poverty in India, the low GDP per head. So we're coming from a low base. That's very, very important. I think aside from that, I think you've got a lot of great companies that are developing in areas like pharma and technology in particular. And I think through all of this, you've had pretty prudent monetary policy. They've kept inflation under control, although, it's higher than it is in most developed economies, but it's not like it's running at 10, 15, 20%. And that's allowed a degree of flexibility in monetary policy. And, most people expect them to cut interest rates. I think they meet on Friday, the RBI. I think the one doubt there about India is they've always had a challenging fiscal situation, although right now the fiscal situation, budget deficit, is a little bit better than it's been. And that allowed them to come through in the budget a few days ago with some tax cuts, which I think the economy needs, because there is evidence that at the higher end of the economy, the banks are getting tapped out in terms of lending. People are getting tapped out in terms of their, unless you're super rich, of course, in terms of the debt you're putting on. And therefore, in order to continue this strong growth performance, which let's say on average 7% growth, you've got to spread the wealth, so to speak, a bit more. So I think it's a bigger challenge now. But I think the general answer to that is they've had decent fiscal policy, now a bit of a challenge. They've had excellent monetary policy. You're coming from a low base. You've got pretty good institutions. And by the way, every time I go on Indian TV, which is quite frequently, they're always worrying about the currency because it drifts down against the dollar. Well, if the dollar's going up, every currency is probably going to go down against it. And if you look at a chart of the Indian rupee, it is absolutely drifting lower, but in a very controlled way. And so you roll all that together, and I think people feel comfortable with paying a premium valuation for the market, which of course they do. Although, one's always got to be careful that it doesn't get too rich and therefore becomes a big sell. But that's what I think India is doing well. But it's so important, Tom, to remember where these countries have come from. In other words, very low levels of GDP per head. This was true of Latin America in the 1990s. It was true of Central Europe in the 2000s after the wall came down, or even the 1990s, I guess. And it's true of other countries around the world. But that, I think, has been a big factor with India.
Excellent. Before we move on to Latin America, which I want to spend some time on, given we're seeing probably the beginning of the end of the war in Ukraine, do you see prospects of Russia getting back into sort of, because it was prominent member of the emerging markets and investment index, but do you see this changing? I mean, how long is, let's say if in the best case scenario, if the war were to end in February, how long will it take for Russia to get back on the radar screen, and not just within like hedge funds, but MSCI and people like that, to get it back on the index?
My guess is it'll take a while. It'll take a couple of years, I would think, because it's not a political judgment, particularly. There's a series of boxes that would have to be ticked, I think, for this to happen. And the most obvious one you would have to tick would be the removal of capital controls. I remember when the invasion of Ukraine happened in, I guess, February 2022 now, amazing, over 3 years ago, well, 3 years ago, saying to an old colleague of mine who will remain nameless, when Russia put on capital controls and said they're going to get kicked out of the index, he said, no, they're not, they're too big. Well, they were 6% of the index at the time. Well, sure they did. Because for MSCI, and this is not just for emerging markets, for any index they've got, the big no-no is capital controls. Investors need to be able to put their money in and take their money out without there being many constraints, or any serious constraints anyway. Russia has full-fledged capital controls. They would have to come off straight away. And how quickly that would happen, who knows? Because presumably, and I'm not trying to be smart geopolitically, because I'm not smart geopolitically, but you need not just a ceasefire and a resolution of the war, but you need some sort of quote-unquote peace treaty as well. Because the other part of the equation, Tom, would have to be, I think it wouldn't have to be for MSCI, but I think in practical terms it would be the removal of nearly all the sanctions on Russia that are in place at the moment, across the economy, which would then be a situation, no capital controls, no sanctions, would encourage foreign companies perhaps to go back in, which of course a lot of them have withdrawn. So it'll happen, I think, once the war is settled, but I think it may take a fair time. And I would put it at 2 to 3 years, no earlier than that.
Yeah, interesting. Okay, so Latin America, which I know is one of your favorite places to talk about. I want to talk about Brazil first, because, well, a couple of things that sort of my theories, but see how you thought about it. So obviously, Brazil has its own issues, and mainly political issues. Recently, there are, I don't know, I don't want to call them rumors, but Lula has been sick. He's been out of the eye. He looks feeble in the papers, and so just to throw it out there, what would let's say a decreased influence of Lula do for Brazil, given that the potential, person taking over Lula is more of a centrist? I don't know if you study Brazilian politics, which is a podcast in its own, but what's your views on Brazil and this potential scenario of Lula kind of fading out of the picture?
Yeah, it makes you wonder, actually, Tom, whether one of the reasons at the margin, it's marginal. One of the reasons Brazil has done so well, up by 12.5% in dollar terms this year, could be because people do worry that Lula, or do think that Lula's fading from the scene. He's obviously had a couple of very major surgeries. I'm sure you saw this, and the listeners will have seen this. And there was an article in The Economist about, I think, a couple of weeks ago, arguing, well, who on the left wing of the Brazilian political spectrum could possibly take over from Lula? Answer: nobody has any strong candidate. So I think you're right. It would tend to be perhaps a move towards the center in Brazilian politics. And in other words, I think it's fair to say, and you and I have been studying and working in Latin America for many years. It's Lula or nothing. And even when Lula wasn't in power and Dilma Rousseff was in power, Lula was certainly pulling some of the strings behind the scenes. So to lose Lula from the political situation, let alone the possibility, sadly, of his demise, would, I think, create a big problem for the left wing in Brazil. Now, having said all of that, the history of right-wing or right-wing governments doing well in Brazil has been limited since the 1990s, when Cardoso, of course, was very responsible for the Real plan, which killed inflation, hyperinflation in Brazil. So the scope for that to, for the right wing and centrists to do better. I think the point I would make, and of course this is typical me talking more about the short term than the long term, but I think what's gone on is Brazil was such a terrible performer last year that as soon as you got any hint that the dollar was turning a little bit, although I think the jury's out as to whether it's really turning or whether it's just pausing in a trading range, people piled into Brazil. The real went from 630 or whatever it was against the dollar to below 6. So a nice rally, and Brazil was, Brazil was a big beneficiary of that move. And as someone once said to me, in Brazil, it's never as bad as you think it is. It's never as good as you think it is either. And right now we're moving towards, I think, a situation where sorry to pour lots of metaphors into this, where the glass is seen to be half full again. Now, Brazil has got enormous fiscal challenges, much worse, I think, than 10, 15, 20 years ago. And so there has to be some tackling of government spending. There has to be something on taxes. But to answer your specific question, I think the demise of Lula or the withdrawal of him for the political situation would give you, most likely at the appropriate time, either the next election or before then, a more right-leaning government or centrist-leaning government, which I think would be able or would seek to do more sensible things on the fiscal side, against a background where, as ever, the central bank in Brazil has been pretty reliable. They had very, very, very high real interest rates, which did nothing for them last year because people were so worried about the fiscal side. Well, now the dollar may be turning and people thinking Lula won't be on the scene forever. Then you're starting to see investors begin to say, okay, let's ignore the fiscal thing for a minute. We may get some improvement of that in the long term. Currency's cheap, stocks are cheap, they've done poorly, dollar's going down, let's start to invest again. And, this is how another cycle goes. But at the end of the day, Brazil faces very, very significant fiscal challenges, which will have to be dealt with sooner or later by whatever government we have, either today's or a more centrist government in the future.
Yeah, and I guess from that standpoint, when you look at, you mentioned the central bank, and I think prior to the recent change, I think Brazil's the central bank head was notable as one of the best central bankers in the world, right? He had a great reputation, and the Brazilian independent central bank is written in the constitution.
Yep.
So with that said, these central bankers have not yet they're still taking kind of rates ticking up as opposed to going down in terms of the Selic rate. So, if you're an investor in Brazil, you can get 1% a month. You're not going into equities. So taking politics out, what is the central bank seeing that's preventing them from lowering the rates? Because we did have the expectation 18 months ago in Brazil that rates were going to go down to 8%, whatever, and they're still stuck almost at 13. So what's happening out for economically?
I would say two things. First of all, I think the central bank probably would like ideally, and they may have to wait a long time for this, would like ideally to see some action on the fiscal front before they start to ease monetary policy significantly. And I think, secondly, they probably want to know that the current situation that Brazil is in, i.e., benefiting from a weaker dollar and some money, foreign money coming back, whatever the locals are doing, to have some sense that that may be durable for more than 5 minutes. And I think there's probably those two. In other words, it's a safety first, approach, if you like. Now, what typically happens in Brazil, as you know well, is once rates start to move, they can move quite quickly. And I would think that is going to happen at some stage over the course of 2025, unless, of course, we get loads of tariffs, not on Brazil necessarily, but loads of tariffs around the world, which pushes the dollar back up again, in which case maybe the central bank could be waiting to see how the tariffs play out, frankly, as well. And that would slow things down. But I think they're being uber cautious because of all those factors. And it probably takes another tick down in inflation, possibly some fiscal action, possibly some reassurance that foreign money's coming because the dollar's weak, before they would take that action. But what I would say is I don't think this is reflective of a particular change in the way the central bank is working, the BCB is working, even under a new president. I think it's just typical Brazil that they want to be a little bit cautious. And frankly, it's that caution on rates which is probably contributing to what has been a very, very nice equity return so far this year.
Yeah, and just finishing up in the southern part. Obviously, we've had a lot of enthusiasm with Milei coming into Argentina. The market has been probably the best performing market in the world over the last 2 years that nobody even knows about, right? I mean, nobody's even paying attention, and Argentina in equities have held the gains, right? So, given Milei's, again, I don't want to say he's close, but he's friendlier than Trump, and given that Argentina is the only, I guess you want to say, center right wing political thing left in Latin America. Everyone's left wing except for Argentina. How do you think this plays out, Jeff? Do the good times keep going, or is there going to be a hiccup? Because it looks like he's got great momentum here.
I mean, it's a real $64,000 question, as we used to say, because I got to say, perhaps a little bit more than enthusiastically than that situation I'm going to mention, but this reminds me quite a bit of the early months, the early quarters of the Macri administration, 2 administrations ago, before Christina came back. I've had the view for a long time, and it's true with emerging markets generally, that 4 years may be too short of a term for presidential term for countries to do what they need to do to turn around what, if it's a really, really, really tough situation, they have to turn around. But having said all of that, I think you've got to admit that you've got to accept that Argentina is doing better and doing more reforms and doing moving away from the bad situation they've had in the past to a greater extent than was the case with Macri. And Milei is demonstrated a great ability against the background of really having no major congressional caucus support, whatever, to force a lot of this stuff through. Now, it'll be interesting to see what happens in midterms later this year. I guess it's later this year. It'll be interesting to see what happens in the next presidential election, of course. But at this point, I would give them the benefit of the doubt and say this may be the best chance Argentina has had since the 1990s under Menem of actually turning this economy around on a long-term basis. For me, the issue with Argentina has always been the fiscal side, in particular, the poor fiscal performance at the provincial level, which has basically been spending money like a drunken sailor for years and years and years. You don't just need to tighten central government spending, you need to tighten provincial spending, which has always been, as I say, the problem. And I think the way they've managed the currency by slowing the depreciation has been very good. The next issue, which is going to be a really big hurdle, if you imagine we're going around a course here where the horse has got to jump a series of fences. The next fence they've got to jump is a really high one, and that is to get rid of capital controls, to remove them. And how do they manage that? And does the currency come under pressure? That will be much easier to manage in a weak dollar world than in a strong dollar world. So I am very optimistic. Again, an ex-colleague of mine from UBS days said to me earlier in the year when we met in New York, and he said, it's pretty sad. This is right at the beginning of the year before Brazil really started to do well. He said it's very sad when the best recommendation we've got in Latin America these days is to look at Argentina. And I still think Argentina is very, very well this year. Of course, it's part of may not even be part of the Frontier Index. I've lost track on that one. But they need to remove capital controls. And if they get capital controls removed successfully, they will then go back into the EM index, probably before Russia, by the way, and that will open Argentina up to a much, much bigger pool of money. So I'm pretty optimistic, but we've been here before. We've seen this movie before. We just got to hope for a better ending, and I do think they've got a good chance of getting it right. It's just, it's never done till it's done, basically.
Yeah, I think you're right. I think the one thing that people have underestimated is Malay, and he's done incredibly well. And one thing that could sort of help with all the things you're saying is that historically investors, especially European investors, love Argentina, and there's
Yeah.
a kind of a love affair, a secret love affair, and the foreign money coming into Argentina could help stabilize this whole process of opening up the currency. That's my only
Yes,
two
and
cents.
to be fair, Tom, what that will be self-feeding because once the capital controls go, foreign investors will be quote unquote allowed by their trustees to go back in. With capital controls, obviously the money is not coming in, so could potentially, particularly in the face of a weaker dollar, be a virtuous circle.
Before we go to Mexico, are there any of the other countries in Latin America, Chile, Peru? I don't know if you want to make any comments on Venezuela. They're all politically left. They all have economic challenges. Probably every single one of the current governments will be replaced in the next election because they've done so poorly. Anything to talk about any of these countries before we go to Mexico?
Well, first of all, I think what's fascinating is Colombia is the best performing emerging market this year. It's about 16, 17%. And that's interesting. I think it may well have something to do with the threat of tariffs, which were then immediately removed. That was the first transaction, so to speak, on tariffs that Trump did. But I think the one point I would highlight, which I thought was very interesting, and I commented on this on LinkedIn, is the new pension reform in Chile, which I think is tremendously important because Chile, as you know well, went from being the kind of the star of Latin America in terms of performance, in terms of institutions, in terms of reforms in the 80s and 90s, to a situation where during the pandemic, and I think also even before that, people were allowed to raid their pension funds to support spending. And of course, we had all these riots as well over bus fares. Do you remember 3 or 4 years ago? I think the sensible reform to the pension fund system, I think, is going to allow that that driver, if you like, of global sentiment, local sentiment towards financial assets to improve. And I think while not suggesting in any way that we are going to go back to the golden age of reforms and therefore economic growth performance in Chile, but I think it does, and it passed, of course, during in a left-wing time of a left-wing government, is I think going to really improve global sentiment towards Chile. And if you look at some of the other markets in Latin America, I would much prefer to argue that if it's a long-term investment there and a medium-term investment there, aside from some of the other stuff we've mentioned, Chile would be that it as opposed to Peru or Colombia. Let me mention one other thing, as we all know on this call. There's been this anti-incumbency factor around the world. And you rightly say, most of these governments are going to get replaced by probably more right-wing governments down the road, and I think that's a factor that will benefit everybody, arguably. And I think Chile would be a part of that. What's interesting to me is even Mexico, but certainly um, the rest of Latin America overall, including Mexico, have benefited this year from the fact they did so poorly last year, because you see the weaker dollar currencies are doing better, and people are being bottom fishing in some of these other markets. And the one market aside from Brazil, you can argue where there's good case for that, would in fact be Chile, because of the structural reforms that seem to be coming back into the country.
Agree 100%. All right, Jeff. So Mexico, obviously, has been in the news with the tariffs. I'll just give you my little. You can comment on my theory, but so I'm actually very bullish on Mexico, and my reasonings is that I did I did a deep dive on the new president. I think she's very smart. I think she's very pragmatic. The problem or the concern was even before Trump, after the election, was that she was going to be just a continuation of AMLO.
Yeah.
And I think Trump is giving her an opportunity to break away from AMLO for a lot of different reasons. So that's why I'm bullish. But I'm forgetting about what I say. What is your sort of talk about the economic part and the markets? What's your feeling on Mexico? And do you agree with me? There's a positive opportunity there.
I mean, I share some of your thoughts. I'm a little bit more cautious, and I'll tell you why. Because the economy is just really barely growing at all. It has been barely growing at all for a while. It's been a poor performer, even in an environment where you've been able to send goods freely, or pretty freely anyway, from Mexico into the US, whether it's Chinese electric vehicles being built in Mexico or whatever it might be. So I think you're right. I think Sheinbaum will actually be potentially a break from AMLO. I think she is very smart, and I think she dealt with the threat of the tariffs from Trump very effectively, and I think that's to her credit, and that's very beneficial. But I worry to a certain extent about, number one, have the tariffs really gone away, or have they just gone away for now? That's one point, because the tariff, Mexico sends 80% of its exports to the United States. It's a fairly open economy, so the proportion of Mexican GDP that is accounted for by exports to the US is very high. And so were there to be a tariff battle, if President Trump decides to fully throw NAFTA and the USMCA into the trash can, which still obviously could be possible, and the Mexican economy hurts very badly from that. And that would be against the background where the economy struggled for quite a while anyway. The industrial dynamism isn't great in Mexico. And then you've also got the security issue as well. So again, it's me being too short term, I'm sure. Again, a weaker dollar would be very beneficial. That will have helped Mexico, help people to go back in this year. There are some great companies in Mexico, of course, but I kind of worry about the big picture in Mexico. Now, if we were to know now, which nobody does know, but if we were to know now that that was it, the threat of a trade war is never going to happen, and Mexico is not going to have tariffs imposed on it, well, then I would be inclined to be more bullish and move in your general direction. But I think it's a show me story. And when I came into 2025, I did say, notwithstanding my view that I wasn't sure the dollar was going to fall sharply at this point, because it would depend on what Trump did with tariffs, I said I felt Brazil was a much better bet than Mexico, and that's been a good call. But frankly, I wasn't really expecting Mexico to start the year up 6 and a bit percent, which is what it's done. So as far as I'm concerned, there are domestic challenges mainly on the growth front. And I would want to know, notwithstanding Sheinbaum's response and cleverness with dealing with the threat of tariffs, but I need to know that that's it, and we aren't going to see, the resumption, so to speak, of a tariff war between Mexico and the US over the next few weeks and months.
What will be the impact if there is some progress on the border, specifically in sort of eliminating or reducing the dramatic impact that the cartels have on not just the trafficking, but more of sort of economically them controlling that whether they're trying to control the avocado. But so if there is an impact, a reduction of the narco impact from a business standpoint, how do you see that changing things in your?
That would be very, very positive indeed. In fact, one of the things I meant to mention in my rambling answer before, which I didn't get around to, is I think one of the reasons that foreign investors are a little leery about going into Mexico right now is the security situation is clearly not good. Visiting companies is not as easy as it used to be, not as safe as it used to be. Whatever, wherever that company may be, especially if it's outside the big cities. So I think were there to be significant progress on stopping the flow of illegal drugs from Mexico into the US, and specifically to try to break down the role of the cartels, I think that would be an enormous positive for Mexico in terms of domestic consumer confidence, but above all, corporate sector confidence, let alone the fact that I think it would encourage more foreign investors to get involved, not only because it would be easier to travel there, it's not just about that, but that they could see that some of the benefits of this to the local economy will be quite significant. So I think that would be very, very important, because you know very well, it's very hard to have any conversation about Mexico these days without talking about the high murder rate, the dominant role of the drug cartels, especially in certain parts of the country. If you could work on those two things, which you probably could do together, so to speak, I think that would really help sentiment towards Mexico, and that would make a huge difference. But we've seen them try this before, and maybe with President Trump's policies, we may see more progress on that. That remains to be seen, but that would certainly, at the margin, make me more bullish about Mexico. I think it would be very good for economic growth.
Yeah, I agree. Before we finish up, Jeff, I always like to hear your opinion on your home country, the UK. Obviously, you got there's so much to talk about, from political to this whole thing about free speech. But can you touch on all of that? What's happening in the UK, and can you put it at the end, put it in context of sort of what the relationship with the EU? But give me your home country appeal.
How long do you have? Anyway, first thing to say is the Labour Party under Keir Starmer is suffering again from a very typical Latin American situation, where you come into office very popular, and within months you're very, very unpopular. The difference now for the UK and for Labour is they have such a giant majority in the House of Commons. Frankly, it doesn't matter. They're going to keep going. That's one point. But the government's terribly unpopular. Excuse me. I think that the economy is flat as back. It's just doing nothing. And it's been made worse by these rather perverse fiscal actions that Rachel Reeves, the Chancellor of the Exchequer, has made. And the one I want to focus on in particular, and everyone knows what's coming here, is that they said no tax increases on ordinary people, low-income people, middle-income people in the new government. Well, sure, they haven't raised taxes on middle-income people and low-income people, but what they've done is increased employers' national insurance contribution. They have to pay for every employee a company hires or has on their books, and that effectively, economically, sort of works like a tax on labor, on the workers, not because they get taxed, but because it's going to put corporate profits under pressure, corporate margins under pressure, and is going to lead, frankly, to layoffs, etc. So I think that was to talk about, put it in soccer parlance, that was a bit of an own goal. And I think they're flailing around now is to know exactly what to do, because the budget and deficit numbers are awful. The growth rate is poor. Sure, inflation's down. Well, it's ticked up a little bit recently, but it's down, and they're going to be able to cut interest rates more. But we had a move in sterling earlier in the year and late last year, which did remind people of the very short-lived Liz Truss administration, because of the impact it had on sterling and the impact it had on obviously gilt yields. Now gilt yields are pulling back in again, of course, partly because US bonds are doing better. So what I would say is the fiscal challenges are great, and that's the biggest the biggest challenge this government has got, which has suddenly become very unpopular. And Keir Starmer just doesn't look as if he's in control. And haven't we seen this movie before, as far as the UK is concerned, over the last several years? All I will say is that more importantly than all of that is that my own Premiership's football team, Nottingham Forest, are actually right against the expectations, third in the league, and people need to focus on that heavily. But no, seriously, and also my wife and I have bottom fished and bought a small apartment in the Cotswolds in the UK for a song, basically, for a very, very low price, particularly in dollars. So I think they need foreign money coming in. I guess I'm foreign money despite my accent. And I think that it's very interesting to see what's going on, because people do not have a lot of confidence in the economic policy of the UK government, specifically fiscally, primarily because this was a really stupid piece of fiscal policy to raise those national insurance contributions. So the economy is very weak, and I think it's going to stay weak for a while until we get more sensible fiscal policy, for which, by the way, they have no room, because deficit GDP is high and debt to GDP high is going up every day.
And correct me if I'm wrong, but the UK market's been pretty strong,
Yes,
right?
it has been strong. And to be fair, that's true with Europe as well. And I think to a certain extent, that is also a bit of bottom fishing, because Europe has done so poorly for so long. There is this famous statistic, and I read a version of it today, I think, that the highest market cap of a company in Europe that has been incorporated in the last 50 years is well below $1 trillion. Whereas you've got all these new companies in the US. So, you know what they all are, the Magnificent Seven and a lot of other companies as well. So I think we're in a situation where the European markets, including the UK, are very traditional markets in terms of market structure, banks, utilities, chemicals, etc. And I'm missing hardly any technology. And so those are, let me rephrase, a lot of the market cap of the UK and European markets is in quote unquote export stocks, which benefit from a cheap currency. So the weakness of the US dollar that's begun to, the strength of the US dollar that was throughout all of last year and the other part of this year, big benefit for European stocks because, of course, of making their exports cheaper. Well, these are the things I used to say to people, and I've never heard anybody ever say this before, is that when the dollar is strong, emerging markets do badly because their currencies go down and people leave. When the dollar is strong, European equities do well because you've got all these companies with big foreign businesses, and that's what's going on. I think it's a bottom fish. They're cheap. They're benefiting from the strong dollar. And so, if you ever had a good example here, ever wanted a good example of economies don't reflect the stock market or vice versa, what's going on in Europe this year, particularly in the UK, but also the German government basically collapsed, and we're having an election very shortly. The French government collapsed, etc. All of those things are going on, and yet the equity markets are rising nicely. And actually, for the first time for a long time, the US market is actually underperforming developed markets last year, which is pretty interesting. Although how long that lasts, I'm not sure. But yeah, markets are doing well, economies not so much.
Yeah. Jeff, where can people follow you? I know besides the LinkedIn, LinkedIn, I'm going to put a comment on your LinkedIn in the comment section so they can follow you on LinkedIn. Anywhere else that they can follow your musings, Jeff?
Yeah, not really. I put all my stuff on LinkedIn, and that would be where I'd ask people to follow me. I've got a lot of people look at my stuff and connected to a very large number of people, and that's good. I'm enjoying my retirement. I don't want to do anything else particularly, but still, I love to talk about markets, love to write about markets, and you'll be seeing some more things from me over the next few days for sure.
Jeff, thanks very much, and we'll see each other on the golf course soon.
Yes, thanks, Tom.
Right.